For 5,000 years, silver was money, not an investment, not a commodity, not a speculation, money. It was the medium through which empires collected taxes, the substance that paid soldiers and settled debts, the foundation upon which trade routes spanning continents were built. When Rome expanded across the Mediterranean, its legions were paid in silver denarii. When Spain conquered the Americas, the silver extracted from Potosi became the currency that connected Asia, Europe, and the New World for the first time in human history. When the United States was founded, the dollar was defined not in abstract terms, but in precise weight, 371 and 1/4 grains of pure silver. This was not symbolic, it was constitutional. Article 1, Section 10 of the U.S. Constitution prohibited states from making anything other than gold and silver coin legal tender for the payment of debts. Silver was not merely accepted as money, it was legally mandated as money. And then, within the span of a single century, silver was systematically removed from the monetary system, demonetized, declared obsolete, reduced from the foundation of global commerce to an industrial input, something used in electronics and solar panels, not in the settlement of accounts between nations. This transformation was not accidental. It was not the natural evolution of markets. It was policy, deliberate, sequential, and coordinated across the major economic powers of the Western world. The question is not why silver prices fluctuate. The question is why silver was removed from the monetary system in the first place, and what its periodic reemergence during times of stress reveals about the system that replaced it. There is a standard narrative about silver's monetary history. The narrative suggests that silver was once useful as money because economies were simpler, transactions were local, and the technology for more sophisticated monetary systems did not yet exist. As economies modernized, as banking systems developed, as the scale and speed of commerce increased, silver became impractical. It was heavy. It was inconvenient. It could not keep pace with the demands of industrial capitalism. According to this narrative, silver's demonetization was progress, a natural evolution from primitive commodity money to efficient paper currency, and eventually to the digital systems that dominate today. This narrative is convenient. It is also incomplete. Because silver was not abandoned due to its impracticality. Silver was abandoned because it constrained the ability of governments to finance expenditures beyond their means. A monetary system anchored to physical silver, or physical gold, imposes a limit. The money supply can only expand as fast as the metal supply expands. Governments cannot print silver. They cannot conjure it from nothing. They must either tax, borrow, or mine. This constraint is inconvenient for governments that wish to wage wars, fund programs, and maintain power without the political cost of explicit taxation. The removal of silver from the monetary system was not about efficiency. It was about control, and the moments when silver reemerges into public consciousness, the moments when premiums spike, when demand surges, when the metal becomes difficult to source, those moments are not random, they are signals. Signals that the system built to replace silver is under stress. The first major demonetization of silver in the modern era occurred in 1873. In that year, the United States Congress passed the Coinage Act of 1873. The legislation was technical, dense, and largely ignored by the public at the time of its passage. But buried within its provisions was a fundamental change. The act eliminated the standard silver dollar from the list of coins authorized for minting. Prior to 1873, the United States operated on a bimetallic standard. Both gold and silver were legal tender. Both could be brought to the mint and coined into money at a fixed ratio. The dollar was defined in terms of both metals. After 1873, only gold remained. Silver was demonetized, not by public referendum, not by constitutional amendment, but by legislative technicality. The consequences were not immediately apparent. But within a few years, as the implications became clear, the act acquired a name that persists to this day, the Crime of 73. The crime, as critics saw it, was the deliberate contraction of the money supply. By removing silver from its monetary role, Congress had effectively reduced the amount of money available in the economy. Prices fell, debts became harder to repay. Farmers and workers who had borrowed in inflated dollars were now required to repay in deflated dollars. The beneficiaries were creditors, banks, bondholders, the financial establishment of the East Coast. The victims were debtors, farmers, laborers, the producing classes of the South and West. This was not a conspiracy theory. It was observable economic mechanics. When the money supply contracts relative to the goods and services in an economy, prices fall. When prices fall, the real burden of debt increases. The debate over silver dominated American politics for the next quarter century. The populist movement of the 1890s was built largely on the demand to restore silver to its monetary role. William Jennings Bryan's famous Cross of Gold speech in 1896 was in fact a speech about silver, a demand that the United States return to bimetallic money and end the deflationary policies that were crushing agricultural communities. Bryan lost. Gold won. Silver remained demonetized. But the pattern established in 1873 would repeat. Whenever the money supply contracts, whenever the purchasing power of currency becomes a political battleground, whenever the interests of creditors and debtors diverge, silver re-enters the conversation. Not because silver is a good investment, because silver represents an alternative, a form of money that cannot be controlled by the same institutions that benefit from the current system. The second major demonetization occurred 90 years later. By 1964, the United States still circulated silver coins. Dimes, quarters, and half dollars contained 90% silver. They were not merely tokens representing value, they were value. Their metal content gave them intrinsic worth, independent of government decree. But there was a problem. The price of silver on the open market was rising. Industrial demand was increasing. Photographic film, electronics, and other applications were consuming more silver each year. And as the market price approached the face value of the coins, a predictable behavior emerged. People began hoarding silver coins. Why spend a quarter that contains 25 cents worth of silver when you could melt it and sell the metal for the same amount, or more? The rational response to rising silver prices was to remove silver coins from circulation and hold them. This is Gresham's law in action. Bad money drives out good. When two forms of currency circulate together and one has intrinsic value while the other does not, people will spend the worthless currency and hoard the valuable one. By 1964, silver coins were disappearing from circulation faster than the mint could produce them. The government faced a choice: raise the face value of silver coins to reflect market prices, or remove silver from coins entirely. They chose removal. The Coinage Act of 1965 eliminated silver from dimes and quarters and reduced the silver content of half dollars from 90% to 40%. Within a few years, silver was removed from half dollars as well. President Johnson, upon signing the act, assured the public that the new coins would be indistinguishable from the old, that they would circulate side by side without issue. The public responded by hoarding every silver coin they could find. Within months, pre-1965 silver coins had effectively disappeared from circulation. They still exist, in collections, in safes, in private hands, but they no longer function as currency. They function as stores of value, as hedges against the very currency that replaced them. The message was clear, even if unstated. When the government removes intrinsic value from its currency, the population responds by preserving what remains of the old system. They do not trust the replacement. They vote with their behavior. And that behavior, the hoarding of silver coins in 1964 and 1965, was an early signal of the monetary instability that would define the following decade. The 1970s confirmed what the coin shortage had suggested. After Nixon closed the gold window in 1971, the dollar was no longer anchored to any physical commodity. Its value became purely a function of policy and perception. What followed was the most severe peacetime inflation in American history. Consumer prices doubled between 1971 and 1981. The purchasing power of the dollar fell by more than half. Savings accounts, denominated in dollars, lost real value even as they earned nominal interest. And silver, the metal that had been systematically removed from the monetary system, became a focal point of the crisis. Between 1971 and 1980, the price of silver rose from approximately $1.50 per ounce to over $50 per ounce, an increase of more than 3,000%. This was not a speculative bubble, though speculation certainly played a role. It was a response, a collective recognition that the paper currency losing value in wallets and bank accounts was fundamentally different from the metal that had served as money for millennia. The Hunt brothers are often blamed for the 1980 silver spike. Nelson Bunker Hunt and William Herbert Hunt accumulated massive positions in silver futures and physical metal, and their buying undoubtedly contributed to the price increase. But the Hunts did not create the demand for silver. They wrote it, they amplified it. But the underlying demand existed because the dollar was failing in its most basic function, preserving purchasing power. When the price of silver spiked to $50 in January 1980, the exchanges intervened. The COMEX changed its rules, prohibiting new long positions and allowing only liquidation. Margin requirements were raised dramatically. The Hunts, unable to meet margin calls, were forced to sell. Silver crashed from $50 to below $11 within weeks. The financial press declared the silver bubble over. The Hunts were villains. Order was restored, but notice what actually happened. The price signal, the signal that the monetary system was under stress, was suppressed, not by market forces, but by rule changes implemented by exchanges under pressure from regulators and banks. This pattern would repeat. Whenever silver threatens to reveal the fragility of the paper system, mechanisms are deployed to contain it: margin hikes, position limits, regulatory intervention. The question is not whether these interventions are legal or appropriate. The question is what they reveal. If silver were truly irrelevant, if it were merely an industrial commodity with no monetary significance, why would its price movements require intervention? Why would exchanges change rules specifically to prevent silver from rising? The answer is that silver, even after its formal demonetization, retains a symbolic and practical function. It is the accessible alternative. It is the metal that ordinary people can accumulate when they lose faith in paper. It is the indicator that, when it spikes, reveals what official statistics and government statements attempt to obscure. Silver is the stress test the system cannot fully control. The pattern established in the 1970s has continued. In 2008, as the global financial system experienced its most severe crisis since the Great Depression, silver initially fell alongside all other assets. Liquidity panic triggered forced selling across every category. Nothing was spared. But then came the policy response. Quantitative easing, zero interest rates, trillions of dollars created and injected into the financial system, the most aggressive monetary expansion in history, and silver responded. From its 2008 low of approximately $9 per ounce, silver rose to nearly $50 by April 2011, a five-fold increase in less than 3 years. Once again, the price spike was attributed to speculators, to manipulation, to irrational exuberance. And once again, margin requirements were raised, prices collapsed, the narrative shifted to bubble and crash, but the underlying cause, the monetary expansion that made holding paper currency increasingly unattractive, did not disappear. It merely continued. Between 2008 and 2024, the Federal Reserve's balance sheet expanded from approximately $900 billion to nearly $9 trillion, a tenfold increase in the base money supply. The dollar did not collapse. Inflation, as officially measured, remained relatively contained for most of this period. But the stress accumulated, the imbalances grew, and the periodic spikes in silver demand in 2011, in 2020, and 2024 were not random events. They were pressure releases, moments when the accumulated stress in the system became visible in the one market that ordinary people can access. Gold is the reserve asset of central banks. It trades in large bars, in institutional quantities, in markets dominated by sovereign entities and bullion banks. Silver is the people's metal. It trades in coins and small bars. It is accessible to individuals in a way that gold, at thousands of dollars per ounce, is not. When silver demand spikes, when premiums over spot price expand, when dealers report shortages, when delivery times extend, it is not because sophisticated investors have made a calculated allocation decision. It is because ordinary people are voting with their savings. They are choosing to exit the paper system, even partially, even symbolically. They are expressing a loss of confidence that surveys and statistics cannot capture. This is why silver matters. Not as an investment, as an indicator. The current moment deserves examination within this historical context. Global debt has reached levels without precedent. Sovereign debt, corporate debt, household debt. The total now exceeds $350 trillion, more than 3 times global GDP. This debt cannot be repaid in real terms. The mathematics do not permit it. It can only be serviced through continued expansion of the money supply, which means continued dilution of existing currency units. Central banks are aware of this. They designed the system. They operate its mechanisms. They understand its constraints better than anyone. And yet the official position remains unchanged. The system is stable. Inflation is under control. Modern monetary policy has the tools to manage any challenge. Meanwhile, industrial demand for silver is accelerating. Solar panel production requires silver. Each panel contains approximately 20 grams of the metal, and global solar installations are projected to triple by 2030. Electric vehicles require silver. Each vehicle uses between 25 and 50 grams in electrical contacts, batteries, and charging systems. Artificial intelligence infrastructure requires silver. Data centers, servers, and semiconductor packaging all depend on silver's unique conductivity properties. This industrial demand is occurring against a backdrop of constrained supply. Silver mining production has remained relatively flat for a decade. Recycling has increased but cannot keep pace with demand growth. The result is a structural deficit. More silver is consumed each year than is produced. The difference is made up by drawing down above-ground inventories. But inventories are finite. This creates a situation where silver faces demand pressure from 2 directions simultaneously. Industrial users need silver for production. Their demand is price insensitive in the short term. A solar manufacturer cannot simply stop using silver because the price increased. They need the metal to produce their product. Monetary demand emerges during periods of system stress, when confidence in paper currency erodes, when inflation exceeds official statistics, when the gap between government statements and lived experience widens. People seek alternatives. Silver, as the accessible precious metal, absorbs this demand. When both pressures converge, industrial necessity and monetary anxiety, the result is not a gradual price increase. The result is dislocation, shortages, premium expansion. The breakdown of the unified pricing mechanism that assumes silver is simply another commodity. There are beliefs about silver that deserve scrutiny. The first belief is that silver is primarily an industrial metal that happens to have some historical monetary significance. This framing inverts the actual history. Silver was money for 5,000 years. It has been an industrial input for approximately 100. The industrial applications are real, but they do not erase the monetary memory embedded in human civilization. When people buy silver coins during periods of uncertainty, they are not making an industrial investment. They are reconnecting with a form of money that predates every central bank, every fiat currency, every paper system that has ever existed. The second belief is that silver's monetary role is permanently finished because governments have decided it is finished. This assumes that government decisions about money are permanent and irreversible. History suggests otherwise. The gold standard was abandoned in 1933 domestically and 1971 internationally. Yet central banks continue to hold gold as a reserve asset. The monetary role was officially ended, but the behavior persists. Silver's formal demonetization does not prevent individuals from treating it as money. It does not prevent populations from hoarding it during crises. It does not prevent its price from spiking when confidence in paper alternatives declines. Government decree can change legal tender laws. It cannot change human behavior accumulated over millennia. The third belief is that silver is too volatile to function as a store of value. Silver is volatile. Its price swings exceed those of gold, often dramatically. This is true. But the volatility reflects silver's dual nature. It is simultaneously an industrial commodity subject to economic cycles and a monetary metal subject to confidence cycles. When these cycles align, when industrial demand is strong and monetary anxiety is high, silver moves violently. This volatility is not a flaw. It is a feature. It is what makes silver sensitive to system stress in a way that more stable assets are not. A thermometer that never moves is not useful. Silver's volatility is precisely what makes it an effective indicator. The fourth belief is that modern financial systems have made physical metals obsolete. This belief rests on the assumption that digital systems will always function, that counterparties will always honor obligations, that the infrastructure of modern finance is permanent and reliable. History suggests caution. Every financial system ever created has eventually failed. Every paper currency ever issued has eventually lost most or all of its value. Every institutional arrangement that seemed permanent to those living within it has eventually been replaced. Physical silver requires no counterparty. It does not depend on electrical grids, internet connectivity, or institutional solvency. It cannot be frozen, canceled, or reprogrammed. In a world of increasing complexity and interdependence, this simplicity is not primitive. It is resilient. Silver's current position in the global system is paradoxical. It has been officially demonetized. It is not held as a reserve asset by central banks. It is not included in monetary statistics. It is classified as a commodity, traded alongside copper and aluminum, and yet, when monetary stress increases, silver demand increases. When confidence in official institutions declines, silver premiums expand. When the gap between paper prices and physical availability widens, silver reveals it first. This is not because silver investors are irrational. It is because silver retains a function that official classifications do not recognize. Silver is the accessible exit, the alternative that does not require institutional permission, the form of savings that exist outside the banking system, outside the digital infrastructure, outside the control of the same authorities whose policies created the stress in the first place. Central banks accumulate gold because gold is the reserve asset of last resort. Populations accumulate silver because silver is the money of last resort. The two behaviors are parallel. They emerge from the same recognition that the current system has limits, that those limits may be approaching, and that positioning outside the system, even partially, is prudent. When silver becomes difficult to source, when premiums spike above historical norms, when delivery times extend from days to weeks, the market is communicating something that official statistics cannot capture. It is communicating that trust is eroding, that the paper price is becoming disconnected from physical reality, that the system is under stress. Silver does not cause this stress. Silver reveals it. And when the revealing mechanism activates, when the stress indicator begins to signal, the response of those who manage the system is always the same. Dismiss it as speculation, attribute it to manipulation, change the rules if necessary to contain the signal. But the signal persists because the stress persists, because the underlying conditions that generate the stress have not been addressed. They have been managed, postponed, papered over, but not resolved. This is not a prediction about silver prices. Prices are determined by countless factors: supply, demand, speculation, intervention, sentiment, and chance. No one can predict where silver will trade next month or next year with any reliability. This is an observation about function. Silver functions as a stress indicator for the monetary system. It has functioned this way for as long as paper alternatives have existed. It will likely continue to function this way as long as the tension between physical scarcity and paper abundance remains unresolved. When silver is calm, when premiums are normal, when supply meets demand without friction, this indicates that confidence in the paper system remains intact. People are content to hold their savings in banks, in bonds, in digital accounts controlled by institutions. When silver becomes agitated, when premiums spike, when shortages emerge, when the behavior of ordinary people shifts toward physical accumulation, This indicates something different. It indicates that confidence is eroding, that the system is under stress, that the official narrative and the lived experience are diverging. Silver was money for 5,000 years. It was demonetized over the course of 1 century. But demonetization did not eliminate its function. It merely changed its expression. Silver is no longer legal tender, but it remains a form of money that exists outside the system, a form of savings that requires no counterparty, a store of value that cannot be printed, debased, or defaulted upon. And when the system that replaced silver comes under stress, when the debt becomes unsustainable, when the currency creation accelerates, when the confidence that holds everything together begins to crack, silver re-emerges, not because speculators bid it up, because people remember. They remember that money was once something you could hold, something that did not depend on the promises of institutions, something that existed before central banks and will exist after them. Silver's forgotten role is not truly forgotten. It is dormant, waiting, ready to re-emerge when the conditions demand it. And the conditions, for those watching the indicators rather than the headlines, appear to be approaching. Gold does not rise, confidence falls, silver does not spike, systems crack. The price on the screen is a reflection, not a cause, and what it reflects when it moves is worth understanding, regardless of what you choose to do with that understanding. This is not investment advice. This is pattern recognition. The pattern is clear. The history is documented. The present rhymes with the past. What comes next is not certain, but what is happening now is visible to those willing to see it.